We all know the Reliance Industries Limited, the biggest company of India by market cap, is trading at around 3000 rupees. What if your friend comes to you and say, "Bro, buy its share, it will go up to 10,000 rupees in the next 10 years. Will you buy it?" Well, the answer can be yes and no also. It depends from individual to individual. How? We will discuss that in our today's video of valuation. Hello and welcome back to Finology Ticker. I am Srishti Jain, Chief Product Officer of Ticker, and I'll be sharing a series of videos on how to use Ticker to pick great stock. In our previous video, we learned how to find if any stock is overvalued or undervalued using DCF calculator or discounted cash flow calculator. But what if any company doesn't have positive cash flows? How to value it? Well, don't worry, Ticker hai na? Ticker has two more valuation calculators for you to find out fair value of any listed stock. It can help you know if the stock is undervalued or overvalued as per the current market price. Well, don't believe me? See for yourself. Open ticker.finology.in. Search for any company you like. I am opening Reliance as an example which we discussed in the start. We can see its current price is around 3000 rupees. Now, should you buy its share knowing that it will go up to 10,000 rupees in the coming 10 years? Well, to answer it, we have to discount the future value with your expected rate of return and know its present worth. Why? Because you will get 10,000 after 10 years. But to know if it's worth rupees 3000 today or not, finding its present value is the only solution. Now, the formula for present value is future value divided by 1 plus discount rate to the power of n, which means number of years. As you can see in the Excel, I have shared the formula and also applied it in one of the cell for our calculation. So, to know the present value of 10,000 rupees received after 10 years, we just have to enter it in the formula. I am writing 10,000 in the future value cell. Rate is the discount rate or rate of return which you expect from your investment. It can vary from person to person. Some might be happy with 10% return, some may want 20% return. So, it's your own choice. I want 15% return, so I am entering 15 in the cell and the years is 10, which is our n. As we enter the value, we get the present value to be around 2500 rupees. It is less than 3000, which is the current market price. So, it means we should wait for Reliance to come below this price to buy it. Now, let's change the discount rate to say 12%. So, the value comes around 3200 rupees. So, anyone with 12% return expectation can buy the share now as it's undervalued. Time period also plays a crucial role. Say, Reliance will achieve 10,000 rupees in 5 years only. So, let's find its worth now. Again, I am changing my rate to 15% and years to 5 now. We get 5,000 rupees as the present value, which means it's highly undervalued and priced cheaply at rupees 3,000. Now, coming back to one main thing. How would you know the future price of Reliance Industries is to be 10,000 or anything after 5 years or 10 years? Well, you can estimate or guess or use valuation ratios. The two main valuation ratios used for valuation everywhere is PE and PB. PE is price to earning ratio and PB is price to book value ratio. What is PE? PE, in simple words, tells us how much we are paying for 1 rupees earning of the company. So, if PE is 10, it means we are paying 10 rupees for every 1 rupee earning of the company. The lesser we pay, the better it is for us. And what is PB? Price to book value ratio means how much we are paying for 1 rupees of company's assets or book value. Generally, it is said the lower the ratios, the better it is for investors. But some industries generally command high PE or PB, so one should always compare them based on the peers' average. The formula for PE ratio is price per share divided by earnings per share, and PB ratio formula is price per share divided by book value per share. If we have PE of any stock and its earning per share numbers, then we can calculate price of that company, right na? So, using this, we have created earnings multiple and book value growth calculator in Ticker. It helps us predict company's fair value or intrinsic value and tells us if the stock is undervalued or overvalued. Let's first see earnings multiple approach. It's available for Finology 1 members only. Scroll below the doc section of any company. After DCF calculator, you can get to this one. Here, we have to project how much the earnings of the company will grow in the next 10 years. We can estimate that based on the company's past growth rate or any capex or its business operation or any pending orders which it might have. You can get hint values too in here, which is based on past earnings growth value. Next, you have to enter estimated PE value which you think company will have after 10 years. Companies generally tend to have a stable PE or reach its sector average PE. So you can take median PE values by checking the PE chart in Ticker or take the average of peers PE. Now, what the calculator does is it takes our EPS value after 10 years by growing current EPS with the growth rate you enter, and it has PE value after 10 years. So, it calculates the price of the company after 10 years using the formula of price is equals to EPS by PE, and then discount it to the present value using the formula we discussed in the start. Let's enter the values to find fair value of Reliance Industries. The past earning growth is shown as 10.3% in the hint. I believe that it will grow more than that, as Reliance is Reliance, it can do anything. So, I am entering 12% as the growth rate. Now, the PE in 10th year. Let's see the PE chart of Reliance. Here, we can see its range of 15 to 60. We are taking a conservative average of around 30. Now, the discount rate. As known, I want at least 15% of the return, so I will enter it. The last is margin of safety. It is for the errors we might have done. So, after entering all the values, when we click on calculate button, we get the fair value of stock around 2000 rupees. It can be seen that it's currently trading at a premium of around 30%, meaning it's overvalued. One can add it in the watch list and wait to come below the price to buy it for long term. Remember, we are talking about ways to value a company, and nothing in the video is related to any investment advice. Do your thorough research before investing. Now, the next calculator is BVPS analysis. It does the same thing, but it is good for valuing companies which have high book value or more dependency on its assets for operations, like asset-heavy industries, banks, etc. sector are good for BVPS analysis. Reliance is also asset-heavy. We can get its proper value through this calculator also. So, if I enter the book value growth rate, same as shown in the hint, and PB multiple is generally between 1 to 2x, so I am entering 2 because it's Reliance. Discount rate and margin of safety being the same. After clicking on calculate button, we get fair value around 2200 rupees. The difference between both the calculators is not much. Both says that the company is slightly overvalued as of now and we should wait. You can try for other companies too. One should remember that it's just a valuation tool based on estimates and assumptions. Fair value might differ from calculator to calculator and even person to person as they use different approaches. You have to decide which calculator to use for which type of company. If a company is cash heavy and generate high free cash flows, then you can use DCF calculator. If the company has consistent high earnings growth, then you can use earnings multiple approach. If the company is in asset heavy industry and have high book value, then you can use BVPS analysis. So, try the valuation tools as per the company's requirement and get fair value of any listed stock. You don't need to learn any formulas or do calculation in Excel. Ticker has done everything for you. Just subscribe to Finlogy One and get everything in one place. You know, the great investor Warren Buffett once said, to become rich, buy stocks below their intrinsic value. Ticker helps you find them and also lets you customize it using your own growth rate and return expectations. Try now and pick great stocks for your portfolio. Comment below your doubts if any, and also let us know which more calculators do you want us to add in Ticker. Do like, share and subscribe to Finlogy Ticker for more such videos. Don't forget to hit the bell icon too for quick updates. Thank you.